Welcome to Luck Scout Economic News and Strategies. Today, we're diving into a topic that's more significant than it might seem at first glance. Let's talk about new home sales. You might think it's just about real estate, but there's so much more to it. This isn't just about houses. It's a crucial economic indicator that can tell us a lot about the overall health of the economy. Why? Because new home sales signal consumer confidence and spending power. When people feel secure in their jobs and finances, they're more likely to make big investments like buying a new home, and it doesn't stop there. When people buy homes, they also buy furniture, appliances, and other household items to fill those homes. This spending spree ripples through the economy, boosting retail sales and creating jobs in various sectors, from construction to retail. Think of it like this. A drop in new home sales can be a warning sign. It might indicate that people are becoming cautious about their financial future. When folks are nervous about the economy, they tend to hold back on big purchases, including homes. This cautious behavior can lead to a slowdown in various industries as people prioritize saving over spending. This can impact everything from construction jobs to furniture sales, leading to a broader economic slowdown. So yeah, this number is a big deal. It's a barometer for economic health, reflecting consumer confidence and spending habits. Keeping an eye on new home sales can give us valuable insights into where the economy might be headed. So, what's got everyone talking? The real estate market is always a hot topic, but recently there's been a particular buzz. New home sales dipped recently from 621,000 to 617,000. While this might seem like a minor change, it has significant implications. Now, that might not seem like much, but remember, even small changes can have a big impact on the market. A slight dip can influence buyer confidence, construction plans, and even the broader economy. This dip has everyone wondering, is this a blip on the radar or a sign of things to come? Homeowners, investors, and real estate professionals are all on edge, trying to decipher the meaning behind these numbers. Some experts say it's just a seasonal fluctuation. They argue that the real estate market often experiences minor dips and rises due to seasonal factors like weather and holidays. Others are worried it's a sign that rising interest rates are starting to bite. With mortgage rates climbing, potential buyers might be hesitating, leading to fewer sales. The truth is, it's too early to tell for sure. The real estate market is influenced by a myriad of factors, from economic policies to global events. But it's definitely something we need to keep a close eye on. As we move forward, monitoring these trends will be crucial. Whether you're a homeowner, a potential buyer, or an investor, staying informed will help you navigate the uncertainties of the market. In the coming months, we'll be watching closely to see if this dip is an anomaly or the start of a new trend. The real estate market is ever-changing, and staying ahead of the curve is essential. So, keep your eyes peeled and stay tuned for more updates. The world of real estate is full of surprises, and being prepared is the best way to handle whatever comes next. In the short term, a dip in new home sales can impact consumer confidence. When people see the housing market cool down, they might get a little nervous. They might start to rein in their spending, which can slow down economic growth. This can also impact businesses. Furniture stores, appliance retailers, and home improvement companies might see sales decline. Construction companies might start to delay new projects. It's a chain reaction, and it can have a real impact on people's livelihoods. The impact of declining new home sales goes far beyond just the housing market. When fewer new homes are being sold, it sets off a chain reaction that affects multiple sectors of the economy. This isn't just about fewer houses being built, it's about the broader economic consequences that follow. It's like a pebble thrown into a pond, creating ripples that spread outward. Each ripple represents a different industry or sector that feels the impact. The initial splash may be in the housing market, but the ripples extend much further. Let's take a look at some of the industries affected, starting with the construction industry. Fewer new homes mean fewer construction jobs. This is not just about the builders. It includes electricians, plumbers, and other tradespeople who rely on new home construction for their livelihood. This can lead to layoffs and a slowdown in the construction industry. When construction slows down, it affects suppliers of building materials like lumber, concrete, and steel. These suppliers then face reduced demand, which can lead to their own set of economic challenges. A slowdown in new home sales can put downward pressure on home prices. Lower home prices can affect the wealth of existing homeowners, reducing their ability to borrow against their home equity for other expenses. This can impact existing homeowners looking to sell and make it harder for first-time buyers to enter the market. When home prices fall, it can also lead to a decrease in property tax revenues, which can affect local government budgets and services. When people buy new homes, they usually buy new furniture, appliances, and other home goods. This spending supports retail stores, manufacturers, and the transportation industry that delivers these goods. A decline in new home sales can hurt these industries. Retailers may see fewer customers, leading to lower sales and potentially even store closures. Manufacturers may cut back on production, affecting jobs in those sectors as well. As you can see, this seemingly isolated data point has far-reaching implications. The health of the housing market is closely tied to the health of the overall economy. When one sector struggles, it can create a domino effect that impacts many others. It's a reminder that everything in the economy is interconnected. From construction workers to retail employees, from local governments to manufacturers, the ripple effects of declining new home sales are felt far and wide. Understanding these connections helps us see the bigger picture and the importance of a robust housing market for overall economic health. Potential implications for growth and jobs. Over the long term, a sustained decline in new home sales could have significant implications for economic growth. Remember, the housing market is a major driver of the U.S. economy. When it slows down, the entire economy can feel the drag. Fewer new homes being built means fewer jobs in construction, manufacturing, and other related industries. This can lead to higher unemployment and slower economic growth. It can also impact government revenue as fewer property taxes are collected. So, what does all this mean for investors? First, don't panic. The market is constantly fluctuating, and it's important to stay calm and rational. Instead of reacting emotionally, take a strategic approach to your investments. Here are a few things to consider. Reassess your risk tolerance. Are you comfortable with volatility, or do you prefer more stable investments? Review your portfolio. Is it diversified across different asset classes? Consider your investment goals. Are you saving for retirement, a down payment on a house, or something else? The real estate market can be tricky, especially during times of uncertainty. If you're considering buying or selling a home, it's crucial to do your research and consult with a financial advisor. If you're a buyer, you might be tempted to wait and see if prices drop further. But remember, interest rates are also on the rise, which can offset any potential savings. If you're a seller, you might need to be prepared to adjust your asking price to attract buyers. When the stock market gets choppy, many investors turn to bonds as a safe haven. Bonds are generally considered less risky than stocks, although they offer lower potential returns. Government bonds, in particular, are seen as extremely safe investments. They typically offer lower yields than corporate bonds, but are backed by the full faith and credit of the U.S. government. If you're looking for stability in uncertain times, bonds can be a good addition to your portfolio. No matter what the market is doing, diversification is key. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes, such as stocks, bonds, and real estate. This way, if one asset class is underperforming, the others can help cushion the blow. Diversification is one of the best ways to manage risk and protect your investments over the long term. Right now, the economic landscape is sending mixed signals. On the one hand, we have low unemployment and strong consumer spending. On the other hand, we have high inflation, rising interest rates, and a slowdown in the housing market. This can be confusing for investors, but it's important to remember that the economy is constantly evolving. What's important is to stay informed, be prepared to adapt your strategy as needed, and always invest for the long term. The recent dip in new home sales is a reminder that the market is constantly changing. What's important is to stay informed about economic indicators, understand how they can impact your investments, and be prepared to adjust your strategy as needed. Don't panic over short-term fluctuations. Instead, focus on your long-term investment goals and make sure your portfolio is well diversified. By staying calm, informed, and proactive, you can navigate any market conditions and achieve your financial goals. Please like the video and share it with others. Thank you for watching.